Good morning, everyone. Thanks for joining us today. My name is Chris Keefe. I am the chair of the Business and Finance practice at Nixon Peabody. And welcome to today's Nixon Peabody and Aligned Business Advisory Healthcare and M&A webinar. We've got a terrific team of professionals here today to share with you some insights on the M&A market and the challenges and opportunities presented by the deal-making environment and regulatory landscape in the healthcare arena today. We are thrilled at the turnout for today's webinar. We would like to remind everyone that today's webinar is being recorded. And just a few logistics before I turn it over to my partner in crime from a panel moderation standpoint, Tim Hughes at Align. If you would like to raise a question during today's session, we would like this to be as interactive as possible. Please use the Q&A function on your Zoom interface. We will do our best to get to all of the questions asked during today's session. We do have quite a full agenda of topics we'd like to cover today. So if we don't get to any of your questions during the course of today's webinar, either one of the great professionals from Align or one of my partners from Nixon, Mike Schnipper and Rebecca Simone, who will be our panelists for today, along with Craig Wendell from Align, we'll get back to you and follow up and make sure that they engage in that conversation with you. So without further ado, one other technical point. If you do experience any technical difficulties during today's webinar, please also reach out using the Q&A function. We'll get someone to get back to you as soon as you can and get you sorted out. So with that aside, I'd love to turn it over to my partners, Mike and Rebecca, to introduce themselves briefly. And then Tim will handle intros for Align and introduce Craig, and then we'll get to the substance of our presentation. So Rebecca, why don't you go first?
Sure. Good morning, everyone. Happy to be here. My name is Rebecca Simone, and I am a partner in the healthcare group at Nixon Peabody, based out of New York. I'm 100% healthcare, regulatory, and transactional attorney. That means I spend about half of my time counseling clients on compliance in all areas of healthcare, from federal kickback and Stark law to licensure laws and reimbursement areas. And then the other half of my time working on transactions like mergers and acquisitions, but solely as regulatory counsel. I do have a focus in the digital health and telehealth space that has been booming for obvious reasons since COVID, and also maintain a HIPAA privacy practice. Mike?
Thanks, Rebecca. Mike Schnipper. I'm also a partner in the healthcare group at Nixon Peabody. Actually began my career in the corporate group, industry agnostic, focused on mergers and acquisitions. A little over a decade ago, myself and other members of the corporate group decided to focus on healthcare and life sciences transactions. We now partner regularly with Rebecca and others on the regulatory compliance side to do healthcare transactional work. I spend the overwhelming majority of my time with private equity-backed management service organizations.
Excellent, Mike, and that's helpful. And Tim Hughes here with Align Business Advisory, with Chris's great lead in here at the beginning of the session. I think hopefully the goal today is really to illustrate the great outcomes possible with a collaboration between a robust legal organization like Nixon Peabody, a robust investment banking group like an Align Business Advisory, the team and the expertise that really requires in order to get those transactions not only completed, but done so in a fashion that's going to best deliver a positive outcome for our respective clients. As a moderator here today with Chris, we'll be certainly queuing up the experts on their experience and best practices going forward. And we've got our managing director, Craig Wendell, here at Align Business Advisory with an immense amount of healthcare background, and would like to give him the opportunity to share a little bit more about himself.
Sure. Thanks, Tim, and thanks everybody for joining the webinar here this morning. As Tim mentioned, my name is Craig Wendell. I'm the managing director of deal origination at Align, responsible for a lot of the deal making components of a transaction. We have a particular focus in the healthcare space, having done well over probably 2 to 3 billion of transaction value in that space. I come from 15, 16 years of doing investment banking directly, and with a particular focus of 6 years focus on physician practice management, healthcare IT, pharmaceutical businesses as well. So we have an immense knowledge of how these transactions work. They're a little bit different, a little bit more unique than a traditional transaction that's not included in the regulatory environment that is all about healthcare and patient laws and patient restrictions. and the good stuff that the legal folks on here from Nixon Peabody are experts in, and we'll talk about here today. But happy to be here, and I'll kick it back over to Tim and Chris.
Great. Thank you, Craig. And really, that broader theme today is really going to be that collaboration, really taking the best in breed of different facets within a potential transaction for a client and how to deliver them there. With Nixon Peabody really occupying that significant role on the legal side and all the requirements through that, and then really the actual deal process of origination and working that through to positive terms. Really, when you think about M&A and the ecosystem, as we like to reference, there's a lot of different components that fit within that scope. Ideally, you have the who, the what, the why, and the how. Craig, if you could walk us through really the players within the space. Who do we really feel like this applies to, not only on the selling acquisitional side, but actually the buyer side as well, and the complements around that?
Yeah, you're seeing a lot of, and we continue to see this, and it's really accelerated over the last, call it 5 years, but really a lot of high-profile financial buyers that are incredibly smart, of the likes of, KKR, Enhanced Healthcare Partners, a lot of these larger firms that, are very smart and have an extended track record of success in their portfolio companies. And you're also seeing that attraction from the buyers due to just the nature of healthcare, right? You could think about it as more of a recession-resistant industry, whereas, whether we're in poor economic times or moderate economic times or great economic times, you have to go see your doctor regardless, right? And so, with that coupled with the aging population, doctors are in demand, and trying to get actual appointments is difficult. We're representing a practice right now in the middle of the country, and frankly, some of their primary care, it's a multi-specialty group, but some of their primary care docs are booked out 4 to 6 months in advance, and some aren't even taking new patients. And then you look at the specialty side, the rheumatologist is booked out 4 months as well. So you're seeing demand for their services, and that therein lies the opportunity for investors to be able to invest in practices and help those businesses grow and scale at a level that they historically haven't done. Because let's face it, clinicians, a lot of these businesses are owned by clinicians or physicians, and they're very good at serving their patients, but they find the business side of their overall practice a bit difficult to scale and expand. And so, with the right partner, particularly with a private equity investment firm that you're typically seeing, there are some strategics out there. But really, if you enjoy independent practice and you enjoy independent business, going with a private equity partner is a heck of a lot better, more amicable than, the other alternatives is you sell out to a health system or a hospital system.
Craig, and that's phenomenal kind of broader view there. You mentioned on some of the challenges within that space, but when you think about kind of scale and really the ability to create efficiencies within a broader organization, what is that leads to the what, right? The what is the real end goal here from not only a provider perspective, but a patient service level as well. Walk us through kind of that platform and the thesis behind that.
Yeah, so platform, it's a big buzzword of saying, this is initial investment from an acquirer or private equity firm into your practice, which it is, and that business becomes quote unquote the platform. Whereas, you are, call it the foundation of a house, and then from there you build out other components of the house and additional rooms and additional levels and stories, whether it's through ancillary services or some type of continued expansion to additional specialties, or potentially going at risk with payer contracts, and enhancing your fee-for-service contracts as well, is what these partners and investors are sophisticated in doing. But the platform really gives and if you look on the seller side, the platform really gives the seller the opportunity to have continued equity in the business and have significant equity upside through future growth of that quote unquote platform. Again, whether it's through organic or ancillary things or additional specialties to get into, or it's via acquisition and acquiring smaller practices or acquiring ASCs. There's different strategies to continue to build that platform, and the shareholders and the owners going forward will share that upside of that continued growth of that quote unquote platform.
Craig, that brings up a great point before we get into kind of the how and the mechanics from certainly a legal perspective, but really at a clinician level, the operators within these practices, the business of their business, what sort of upside and opportunities are being created for those folks when they bring in, professional services and partners to help them become more efficient?
Yeah, it frees them up to do what they enjoy doing and why they went to school and how they serve their patients. It provides them with, relieving the stress of the business side of caring for patients, and has them focus really on what they like to doing, and that's clinical care, right? That's seeing patients, that's caring for patients. They don't have to worry about, completing their QuickBooks on a monthly basis, or figuring out credentialing for a new provider, or figuring out what their schedule is going to look like in the next 2 to 3 or 4 months, right? They have in the business side, what these investors bring in is really a ton of resources to be able to manage all that back office type of work, and allow the physicians and the clinicians to do exactly what they're trained to do, and what they went to school, and what they're passionate about, and alleviate them from that business side that is incredibly necessary, obviously, to make money and get paid and manage payer contracts and all that kind of stuff. But it allows some bifurcation between the two, which really harmonizes the business and propels it to the next level faster than what they could do by themselves.
Excellent, Craig.
Right.
And that's a big point. And I think, Chris, kind of volleying back here to you, Craig and I just kind of touched on really that 50,000-foot view, the mechanics, really what that world looks like. But I think we can all attest, the detail of this on the back end, really the logistics from a legal perspective are just as paramount to this broader success story. We'd love to kind of hear what your team, Mike and Rebecca, may be able to add and kind of the mechanics of this.
Yeah. I mean, taking a step back from the business case of why you may transact, the how and the mechanics of it are important. So maybe, Mike, I'll pass it off to you to talk a little bit about the mechanics of a deal, and then maybe you can hand it off to Rebecca to talk about some regulatory considerations.
Sure. And I think, every deal has its own complexity, and they're not all the same, but there is a sort of up the fairway approach, and I'll present that one. And I'll present it from the sell side. So you're a provider entity. You decided that you would like to test the market, whether that's with a strategic or a private equity fund, as Craig mentioned. Often the first step is to meet with guys like Tim and Craig and talk about the market and talk about what the opportunities would look like. Engaging an investment banking firm will certainly make the process easier and more efficient for doctors who spend their days seeing patients and are not as familiar with the ins and outs of mergers and acquisitions. So you've engaged an investment banking firm, you work with them, you put together presentation materials. Sometimes it's called a confidential information memorandum. With the investment bankers, with Craig, with Tim, you identify potential partners that you would like to reach out. You send them non-disclosure agreement, you share some limited information with them. Often what you'd solicit in a first round of a competitive process would be what's an indication of interest. That's a higher level document than a letter of intent. Often the valuation is a range and not a set dollar amount. Assuming that you're fortunate enough to receive multiple indications of interest, you now have a competitive process. Often you share more information. You allow that smaller group of potential partners to review your information and your financials, and you request what's called a letter of intent. The letter of intent is a more fulsome document than the IOI, indication of interest. You're getting more specific on what the requirements are from a partner as far as commitments from the doctors, whether that's through an employment agreement, whether that's through some type of shareholders or partners agreement. Some specifics on the economics of the deal. Again, hopefully you are fortunate enough to get multiple letters of intent and you compare them and you select what you think is the best offer, which isn't necessarily always the highest, but the best offer for you and your partners within your group. And then you're going to sign a letter of intent, which almost always includes an exclusivity period where you negotiate exclusively with that partner During this process, you're doing more due diligence, and due diligence ranges from legal to business to finance to tax to insurance. There are other diligence streams depending on who the potential partner is. Simultaneously starting to work on definitive transaction documents with folks like Chris, Rebecca, and me. And if it all works, you get towards closing. So that is the view from a sell side. Rebecca and I have similar practices in that we both do buy side and sell side, and our buy side clients are often building out platforms, as Craig mentioned. So Rebecca, why don't you talk about some of the considerations a buy side client might come to us to look at when they're looking at, I don't know, maybe a new provider or a new state?
Sure. So like Mike said, we work both sides of these deals, but often working with buyers, they've already got an established platform like a PC MSO structure, and they're looking to add on your sell side entity to their platform. So typically a buyer will have sort of a mega PC or maybe a handful of PCs that they utilize in the country, and their typical procedure may be to add on your PC, assume your PC. If your PC is in a new state, the buyer has to consider the laws in those states. Unfortunately, every state in our country has its own corporate practice of medicine doctrines, licensure laws, laws around PCs. So first, a PC going into a new state needs to register as a foreign PC. Seems easy enough, pay $100, register your PC, unless that state is New York, and it takes several months to accomplish. And so that can stifle a deal. Or California, where foreign registration of PCs is not permitted at all, and a new domestic PC needs to be formed. You also need to consider whether the new state requires the physician shareholder of the PC to be licensed, so that that friendly physician that the PE company has been working with for the last 10 years, is that person licensed in New York? Because you need to be to get foreign qualification in New York. And if not, how long will it take for that physician to get licensed? If the seller's PC is going to be remained intact and relied on, those become diligence questions. Will the seller's PC work as we scale? Is the seller's physician shareholder licensed in multiple states? If we intend to scale geographically, is that physician willing to become licensed in additional states and take on that responsibility? Switching a little focus to corporate practice of medicine, not going to define what it is because I think that the audience here has some understanding, but each state has different permissibility when it comes to how much control a general business corporation can have over a professional entity. And so each state will have different permissibility when it comes to control documents for that physician shareholder. Some may permit a stock transfer restriction agreement. And that means that the management services organization that's generally controlled by that PE firm can dictate when and how a physician shareholder must sell his shares or her shares to a new shareholder. Others with more stringent corporate practice of medicine doctrines will require something called an option agreement. And that means that a secondary physician must be identified at the outset. So the MSO or PE firm can't just decide at any time, Dr. A sell to Dr. B. Dr. B actually has to be identified when that option agreement is entered into. Many states have fee splitting laws, which will dictate fee structures post-closing between the general business corporation and the PC. They can range from percentage of revenue, cost plus, flat fees, or some combination. And, last, Mike's talking about going into new states. If you're going into a new area of healthcare as a buyer, there are some providers that are highly regulated and overly licensed as opposed to just physician practices. And some of those include pharmacies, skilled nursing facilities, home health agencies, ASCs, as Craig mentioned before. All of those types of providers require specific state licensure to operate. And they'll also require change of ownership approvals from the state. And those are not straightforward processes. They need to be started and planned for before you start negotiating those definitive documents, so that they're ready to go as soon as you're sure you're going to sign that agreement. And those applications sometimes include a certificate of need process. And that means that some regulator in the state, the Department of Health, or another regulatory body, is going to determine whether there's actually a need in your state for this type of provider. And they may redetermine that need upon a change of ownership. So important to have good counsel and advisors working with you through those processes.
Without question, Rebecca, and phenomenal points to you as well, Mike. And I think what that, speaks at a more broader sense is that M&A as an industry, as a space, is a living, breathing organism. It is not static. It is constantly evolving and shifting. And the critical need to have a great pulse for, a little sneak in there for all the healthcare folks out there, to have a pulse on this industry as a whole is critical. Craig, I think 2023 saw a number of big shifts take place. It would be great if we could share with the crowd here today what that was and how that is going to lead us into some of the regulatory things we saw with Nixon piping in thereafter.
Yeah, yeah, absolutely. We talked about it earlier in terms of the big players getting in the space. Last year was a big year. You saw behemoths such as Amazon get into the primary care space. You had an $8.9 billion transaction of Oak Street Health that happened. You have Walgreens continue to expand VillageMD, which is their primary care side. So you're seeing a lot of these really heavy hitters focus, particularly on the primary care with some multi-specialty as well. And really what we've seen accelerated over the last 12 to 18 to 24 months is this adoption of value-based healthcare, VBC. You have a plethora of VBC companies that are accelerators that basically help practices go at risk with their contracting. And basically, from a high level perspective, effectively what that means is it's a capitation of your patient population. So you get call it a reimbursement, not reimbursement, but more of a payment, a merit incentive payment based off of the patient population and the cost that you pull out of the health system. So basically, what the whole play is to be able to reduce patient costs, reduce patient visits to their either primary or specialty or lab tests that they have to do to drive down overall reimbursement. It's this whole adoption of value-based healthcare. And so we're continuing to see, further investment in that. Really it also has to do with the where the practices are located throughout the country. There are certain markets and areas that potentially have greater Medicare patients, or more Medicare patients as opposed to fee-for-service patients. And so the Medicare patients are the ones that you can capitate and go at risk with. And in turn for the provider is they get rewarded on continuing to provide high quality care. It's no longer a volume game of, hey, let's test all of these different components of what may be happening. It's more of the less you test, the more opportunity you have for upside in terms of your pass through of savings of that patient savings in the system. So it's really this call it shift, and the healthcare landscape continues to shift almost daily. But it's really the shift of going more value-based and really trying to find ways to lower patient costs and patient spend is really what we're seeing in the market. And you're seeing investments into those value-based companies.
That's helpful, Craig. Rebecca, from a regulatory perspective, what were some of the shifts that you saw last year?
Sure. So, going off of what Craig just said on value-based care, there's definitely an interest in remote patient monitoring, which I think is connected to that sort of value-based care, with physicians wanting to implement tools that can help reduce risk, monitor patients remotely. And in that RPM space, there's been a lot of change in regulation, particularly from Medicare on reimbursement. There's also been some aggressive behaviors in the RPM space and some enforcement actions. So, with innovation comes scrutiny, and so important that if you're doing new things to make sure that you're doing it within the realm of relevant regulation. A recent regulatory trend that has been building over the last several years are states beginning to implement material transaction notification and approval requirements. Some of the most recent states to implement those laws are New York, California, and Illinois. There are about a dozen states that have these rules in effect. And if you're doing a transaction in any of those states, you have to carefully consider whether those requirements apply to your transaction. You may assume that a material transaction law won't apply to you or your transaction because it's nominal compared to what these states' rules say, 50 million, and yours is only a couple of million. But some of these rules actually apply to like a PE that has an entity that does a series of transactions within a year, kind of a roll-up structure. So you do need to look at the big picture of what this particular add-on might mean to a larger transaction. And if one of these laws apply, is it a notification? Is it an approval? How might that impact the structure of the transaction? Another trend, definitely from a regulatory perspective, is in the area of HIPAA. HIPAA's been around forever, obviously, but breaches, particularly phishing breaches, have become a cost of doing business. Despite multiple layers of security that companies put in place, employees still click links that take them to bad places and allow bad actors to infiltrate systems. And even if they do for an hour, there could be thousands of patient information at risk. So that's not a trend, right? That's a problem. But the trend has been that in the last, year to 2 years, every significant breach, maybe more than like 10,000 individuals impacted, results in a class action suit, and or multiple class action suits against the company that suffered the breach. And even just a couple of years ago, a buyer would be scared away by that. They'd say, oh, this is, I'm not going to look at this PC until they settle that suit, until they're all done with OCR, because this is too risky. But they've become so commonplace, and there's a lot of data out there that it's a calculable risk now. And I have seen several buyers, purchase companies, invest in companies that have these ongoing class actions or breaches, because you're able to calculate what that risk is and appropriately escrow for it if it's ongoing. Digital health, telehealth continue to be marketable. That being said, there were definitely too many or many telehealth companies that popped up during COVID. Some of them have just gone away, but some of them are really good companies that are still doing really good things. And so I would expect to continue to see consolidation in telehealth. And the regulatory issues or trends that arise with consolidation is that these are all national companies. And as mentioned earlier, for better or worse, our country is a fabric of 50 states of healthcare laws. So when, a telehealth company focused on the East Coast acquired one focused on the West Coast, a lot of regulatory issues to consider. And briefly, I'll say the last trend that has been growing is PE liability, private equity liability when it comes to False Claims Act cases. It used to be far and few between that you would see a private equity firm named or scrutinized or investigated by the government in relation to a False Claims Act allegation. But that has become more prevalent over the last year or so. So really important when working on these transactions, particularly when there's a PC-MSO relationship, to toe that line so that the MSO or general business corporation does not have too much control over the clinical operations of the PC, regardless of the state you're operating in. If you're operating in a state that does not restrict the corporate practice of medicine, like Florida, right? That does give a lot more leeway and flexibility for the company to get involved in the clinical operations, but they still should not control them and have to consider the risk if they do take more control in a state like Florida. So Mike, I'll pass off to Mike here to kind of chime in from the corporate perspective on trends he's seeing.
No, that was great, Rebecca. I'll just add two things that I know my buy side clients are watching that were very active in 2023 and will continue into 2024. One of which is the antitrust review. It is certainly an interest of our federal government. There was a case commenced in September of 2023 by the FTC against U.S. Anesthesia Partners and its PE sponsor, Wells Carson. That case is pending. There were claims of alleged anti-competitive activity. So we are watching that. Similarly, there is pending legislation in several states and at the federal government level restricting or prohibiting non-competes. And there is often a focus on non-competes as they relate to physicians and the patient choice issues that come along with that. So we're watching those. There's lots going on at the state and federal government level related to those two issues. And, to the extent that our buy side clients are focused on it, our sell side clients should certainly know about it.
Thanks. And Mike and Rebecca, keeping with that, and Craig and Tim, keeping with that topic of sort of what we're seeing as an outlook for 2024, would love to hear from the Align team about sort of what you're seeing in the marketplace now, how you think that that's going to evolve over 2024, those themes and how they'll develop. We do have a great question in the Q&A regarding one particular category about what buyers are looking for. I know our plan is to speak a bit about what we think buyers are going to be looking for in the coming year. So why don't we hand it back off to you guys to speak a little bit about 2024.
Yeah, sure. I think you're gonna see, we touched on it a little bit earlier, but you're gonna see continued investment in this space. Albeit we expect it to be at an accelerated manner. There's a significant amount of capital that's already been raised over the last 2 to 3, even 4 years. Since 2020 and COVID hit and helicopter money came down, which is a slang term for saying, stimulus money really injected into the system. And obviously we're dealing with the results of that through inflation. But setting aside the macroeconomics of it, when you look at particularly the investments for healthcare, you have a significant amount of dedicated healthcare funds that have sprouted up over the last 2 to 3 years. And those dollars need to be put to work, right? And those dollars need to be invested because there's a finite amount of time for when they can make those investments. And so, we're seeing more competition for healthcare related deals, which is great for us. We love the competition of it. It allows us to extract premium value for our clients and really negotiate life after the deal terms as well, and really help position our clients, the partner with their investment partner to really bolster the business and for it to continue to grow. So we expect accelerated investment, and in particular in the healthcare landscape, like I mentioned earlier, it's more recession resistant. And let's face it, we're getting older, not younger, and there's a very large cohort of the baby boomer generation that is needing and seeking increasing healthcare needs.
That's helpful, Craig. And I think that's a great lead in back to you, Mike, to kind of dive in a little bit more on just due diligence structure and some of the other comprehensive diligence items you all are seeing now more so here going into 24.
Yeah, and I will piggyback on Craig, right? There was some slowing in 2023, and one of the results of that is what we call this dry powder concept, right? That there is money ready to be deployed. There's certainly an interest in healthcare. Rebecca mentioned some of the hot areas around telemedicine, behavioral health, very active. There's a bunch of specialties with very active platforms. That said, given what's going on in the macroeconomics, the credit market, et cetera, it is still an environment in which buyers are very focused on diligence. They are taking, in my opinion, longer to close deals than 2021 and 2022, which were very, very busy healthcare M&A years. So the deals we expect will close in 2024, but you may see protracted timelines as there's a focus on what we call quality of earnings, a report that is a financial due diligence component that is often done by buyers. I think you'll see it more. Sometimes it was something that was passed on some of the smaller deals, but I think you'll see very fulsome financial, tax, business, healthcare, regulatory, and corporate due diligence in 2024 as buyers want to address any potential liabilities or other issues pre-closing and avoid post-closing surprises.
Yeah, I'll follow off what Mike's saying on diligence. I mean, I'm always the no fun person to the buyer that wants to do more and more diligence because there could be a lot of risk in that regulatory space. Something else that could be very complex to manage is obtaining government consents. And I mentioned the material transaction notifications before. Those are in play in a handful of states, but some transactions, particularly with companies that have a large geographical scope, will require many state and federal government consents that need to be managed carefully. So, for example, a national mail order pharmacy, which I've worked on several of those transactions, they'll have state licenses in every state in the country, and maybe outside of the country as well, if they're shipping pharmaceuticals. And they'll have a state pharmacy license in all those states. And even if there is a change of ownership several levels up from the pharmacy, meaning, grandparent, great-grandparent level, there are states that will require applications or notifications to be submitted, approvals to be maintained, and it's a state-by-state analysis that does unfortunately need to be refreshed every time we do a new transaction like this, because state boards tend to change their opinions and guidance pretty routinely. And these approvals often will be pre-close. So that requires an executory period between signing and closing. Everybody wants to sign and close on the same day, but if you're investing in a licensed healthcare space, you are a licensed healthcare provider taking on an investor, you have to understand that there will be a period between sign and close. Everybody hates it, and I know why, right? I mean, employees get nervous, they know there's a deal, the deal didn't close yet. The owners want to, or the sellers want to get their cash, right? Sometimes there's management agreements during that period between the seller and the buyer, particularly in like skilled nursing facility space, where there could be very long executory periods between signing and closing. Parties will work around that so that the buyer will become a manager of the entity for a period until the deal is able to close, the consent is able to be approved. Some types of providers will have certificate of needs as well, which I mentioned earlier, but really these kind of national providers that are licensed, skilled nursing, mail order pharmacy, home health, you need to plan for that well ahead of negotiating your transaction.
Yeah, those are, just to add one more thing, those are excellent points, and one that we work cohesively with the MP team, Nixon Peabody team, to really hit those, call it contingencies to close or potential risk to a deal, and mitigate those challenges or those hurdles, and really advise our clients to stay in front of the ball as opposed to react to what's happening in the transaction. And one other thing to note, just and Mike started to hit on it earlier, the things that have changed from a deal structure perspective is we're seeing a little bit more of value given to contingent considerations vis-a-vis earnout, whether that's future growth or sustained performance of the business versus what we saw in 21 and 22, when I mentioned there was a bit more of sloshier money out there being put to work. So we're seeing multiples come down a little bit, and that's due to the cost of capital of where we're at with the Fed funds being 5 to 5.5%. But the good news is we now have a view of the terminal rate of where interest rates are going to be, or at least we think we're very close to that. And so you're seeing adjustments from buyers in terms of their evaluation of businesses and the structures of those businesses. There's multiple different components: cash, equity rollover, earnout, maybe some potential seller note. In 3 of 4 of the deals in the healthcare space we did last year, ophthalmology, plastics, internalists, and hospice and behavioral healthcare, all of them had a component of earnout, which may seem like it's not necessarily quite fair, but if you actually think about it, it gives you the opportunity as the seller to be able to consistently, achieve significant income, whereby, achieving those earnouts. And then also when you achieve those earnouts, it's doing nothing but increasing the equity value of that business. And, you have a rollover percentage of equity. And so you're effectively, call it double dipping in terms of the value of the transaction. So it's an important thing to structure around. Headline purchase price is one thing, but the structure really is the detail that's incredibly important.
And Craig, you'd mentioned that early on, profile of some of these different sort of targets. And it's interesting today's conversation being so complementary to the buy and sell side, and where if there's one shift on one side, that's going to have a correlating effect on the other. Location and where a lot of these dollars are flowing, the sort of patient base, the services. Craig, you touched on structure as far as the actual projects. I think, Mike, this may be a great opportunity for you to kind of jump in at like an MSO structure of the enterprise and what can be a valuable asset going into a transaction.
Yeah, no, it's a great question, Tim. And I'll just use this opportunity quickly. Chris mentioned that there was a question in the Q&A box. So someone has asked, are private equity firms interested in nonprofit healthcare organizations? So that's a very complicated question, and there are state laws, regs that apply to not-for-profits. There's a whole other layer of regulatory approval with often the state attorney general's office. So the answer is yes, but it's much more complicated than the for-profit transactions we've been discussing. And the only other thing I'll add, we could certainly have a separate conversation on not-for-profits, is that I have seen, and I think Rebecca will say the same, in the last couple of years, there is much more joint venture transactions occurring between for-profits and not-for-profits. We're seeing lots of PE-backed MSOs enter into joint ventures with not-for-profit healthcare systems. It's been going on for a long time in the ambulatory surgery center world, but we're seeing that with specialties all across the country. So I think that trend will continue in 24 and beyond. But to answer your specific question, Tim, I think when you talk about going back to the beginning of this presentation, right, like the how of doing a transaction, part of that how as a potential seller is like, when do you speak with advisors? And I'm talking about accountants and lawyers in particular. And that should not be, we want to sell the business next quarter, right? You should start those conversations as early as possible so that folks like Rebecca and I can look at your current structure. Are you a limited liability company? Are you a professional corporation? Are you an S Corp? Are you a C Corp? All of that has regulatory components to it, but there's a significant tax analysis on how you would structure an M&A transaction depending on what your current structure is. Should you be an MSO? If you're not an MSO now, it's a real discussion. The answer is you don't always need to be an MSO to do a transaction with a non-licensed person. We can do that as part of the transaction. But there's some value in having the MSO and being able to take on non-licensed owners before you're out to market. I also like to talk to clients. We talked earlier, I think it was Craig, about like the why and the potential to offload the administrative and management to a strategic or to a private equity firm. But there's also some succession planning that goes into it. Typically in a larger practice, you have some doctors with a shorter horizon to retirement and some with much longer. So we can do some planning around your structure, and then we can do some planning with guys like Tim and Craig on what types of partners we're looking for and how we would go out to market.
Tim, I know we're coming to, getting towards the top of the hour here, and I know one thing that you focus on a lot when you speak to your clients at Align, and we certainly think of with respect to our clients when we sit down and ask them to come back to the why of the deal. They think a lot about their workforces. They think a lot about their own personal goals, but also, the care and the ongoing relationships they have with their clients and their patients. I'm wondering sort of your and Craig's perspective on, on that process, and how do you go about thinking about sort of monetizing that life's work?
Yeah, Craig, I'll take a quick stab here and then lead in kind of the mechanics. But ultimately, you have these owners, these entrepreneurs, these visionaries that have built these wonderful practices and businesses. And at some point, there will be a transition, whether planned or not. And so we always like to implore to our clients, always give yourself more options. And the more options you can lay out for yourself early on, typically you're going to have a better outcome. The unfortunate nature is typically as folks wait longer to make a decision, you're generally left with less options. And the options that you are left with are the ones you probably didn't like to begin with. So, when we start to think about clients and how we can support them and who is that ideal profile, we use the term thinking about selling your business. Because as soon as you can start at least conceptualizing what this can look like, it really helps provide clarity for not only yourself, but it's your team, it's your patients, it's the people that all rely on you to make a good decision. And so we always want to implore to those folks to give themselves the best opportunity to ensure a great outcome for those folks. Mechanically, Craig, what are some of the considerations you would think about structurally that I think would help deliver that for our clients?
Yeah, Mike and Rebecca hit on it previously, is really setting up yourself in advance for a transaction, understanding the tax complications of that, understanding the legal components both at the state and federal level, and optimizing and structuring your business for ultimate success in a transaction. Particularly in physician practice management, there's very limited exit options for these physicians, right? I mean, typically you hang up your lab coat and you have a ceremony and, see you later, see you on the beach. But, if you have the ability, well, you now have the ability to monetize what you've created over those decades that you've been practicing medicine. Obviously, larger groups are more valuable because they have more revenue and patient lives that they look after. So, scaling in that regard is important, and going after key growth initiatives as business owners is important, whether that's renegotiating your contracts, your payer contracts, going with value-based healthcare contracts that we talked about earlier, going into the ancillary side, going into the ASC side, doing research, doing lab testing, doing imaging testing. All of those things that effectively can keep the revenue coming in while those physicians aren't in clinic providing care to their patients. Because the reality is physicians are the assets to these PPM transactions. They make the money with their hands by seeing patients. And so what you want to do is be able to find a mechanism and structure mechanisms, like I said, through the ASC side, for example, to be able to really continue to build that revenue effectively overnight. For example, and you're seeing, this is a good example because you're seeing a lot of what used to be inpatient care go outpatient, and a particular example of that is in the cardiology space. It was in the 90s and 2000s where a lot of these cardiology practices sold out to health systems and hospital systems. And didn't get any equity in those deals. Obviously, it just had a long employment agreement. And now you're seeing those employment agreements expire. And frankly, what you're seeing is these cardiologists that used to be in the hospital setting now go back to independent practice. And they're also building ASCs because you're seeing a significant shift, particularly in the cardiology space, of the procedures going to outpatient facilities, i.e. an ASC, because the costs in the health system, in the hospital, are way too expensive. That those systems don't want to bear that cost. And it's really this further adoption of creating more value in the healthcare system and changing it and trying to reduce and lower costs. So you're seeing all of these shifts happen in real time. And so being able to have an advisor and advisors both on the legal side and in the investment banking side, is incredibly important. It's just very early on. You mentioned it, Tim, when you're thinking about bring on an investor selling a portion of your business, that's really when you need to engage, because the exit options are there. And it's a heck of a lot better than hanging up the lab coat and throwing away the keys to the office.
And Craig, if I can pick, I'm sorry, Rebecca, go.
No, I was gonna use your word piggyback off one item that Craig just mentioned on ancillaries, right? You ways to increase revenue in your business. Those are really the exact type of questions I get asked from a regulatory compliance perspective, right? I've got this practice, I'm sending out my imaging, my DME, my pharmacy. Can I bring that all in-house? Can I bring all that revenue in? And sometimes it's yes, sometimes it's no, sometimes it's yes, but there's this thing called the federal Stark Law, and there's very specific ways your PC needs to be structured as a group practice, which is a very long definition under the Stark Law that permits you to refer certain services within your practice and not sending them out. And then some states have restrictions, like in New York, you can't dispense more than 7 days worth of a pharmaceutical out of your practice. But in Maryland, you can, and it might be feasible to have a pharmacy within your practice. So really important to have the different types of advisors like your team, and how you can potentially increase the monetization of your business. And then also from a legal perspective, what guardrails do you have to put around those processes?
Well, and Rebecca, and I think you and Craig were complimenting each other really, really well there. Ancillary, and what that can be representative of is, for a lot of our clients on the sell side, this can be a really fun opportunity, because so often our clients have been so far in the weeds, just operating the business in their sweet spot. And most of the time they'll go home on a Friday and Saturday evening and be sitting around going, well, gosh, if I was 20 years younger, I would go do X, Y, Z. This is how I would grow the practice. This is how I would add additional value. And so as you start to go through these transaction opportunities and working with partners, that's a focal point of these discussions. It's not only, you create a great business, you've got, millions of dollars of EBITDA, which has been the validator to you to get to the stage for someone smart and sophisticated to come in and give you a big, write you a big check. But in reality, that check is not predicated on what you've done. It's what this practice can do in the future. And so it's all about finding opportunities to grow and expand what's already been created. And so for many of our clients who may not be ready to, hang it up today, the perfect sweet spot is someone that, is looking for a partner now, wants to stay on for a number of years, and bring in a partner that's going to help do all the legwork for all these growth initiatives that you had parked in the back of your head, but just didn't have the desire or energy to go do it yourself. And so that's where you can really, turn on the entrepreneurial hat again and drive the practice forward, which then creates additional value, not only for yourself, but for your people, with an opportunity to grow within a larger organization, ideally providing a better level of patient care, which ultimately is the goal for any number of clients that we support today. And so I think that's the part that most of our clients are pleasantly surprised by, that this is not necessarily this is what I've done, this is what I do, this is what you'll get on the back end. It's what can this be in the future? And where, is the sky the limit? And if someone came in and gave you a bunch of money to go invest with, how would you put those dollars to work? And I think ultimately, when you have a team like Align and Nixon Peabody to help not only illustrate you as the practice, but then also frame, properly on a legal basis, really puts our clients in a great position going forward. As far as kind of structure and kind of what that looks like on the marketability, Chris, I think you were going to try and have Rebecca and Mike kind of talk, what are some of those, really attractive features that you find a lot of the buyers out there, gravitating towards?
Yeah, I think Tim, you hit the nail on the head with respect to sort of refiring that entrepreneurial spirit. We frequently speak with sellers in connection with their conversations with, Align and other advisors about, if you want the most surefire investment in the world, it's adding another dollar of sustainable EBITDA to your business 6 months to 12 months before closing, because that $1 is going to turn into whatever the multiple ends up being. And there is no better return on investment than that anywhere that's legal anyway. And so, that's a conversation that I think, causes people to sort of think about the process a little bit differently, and does kind of refire their desire to sort of introduce some of those optimizations before they go to market as well as after. But I think there are some things that you can do to position yourself well for that process. And maybe Mike and Rebecca, you can chime in very briefly, because I know we're running out of time, but it's worth a good takeaway for folks.
Yeah, I'll go quickly. Two things I would focus on if you're nearing going to market, and it's similar to what Chris said, right? In addition to adding EBITDA, it's making sure you don't lose EBITDA. So I think it's important that you look at your team as providers. Is it a team of mostly partners? Are there associates? Have you made commitments to associates that they'll be elevated? Do you have a compensation system that is driven by productivity? You want to be in a position to tell a good story to the buyer about how this team is sticky and staying and going to be productive after a transaction. And if you don't have that story, then it'll be dictated to you. So I think it's best to get into the driver's seat. And the other one, I think, is having good advisors like Craig and Tim. I mentioned a couple times financial due diligence and a quality of earnings report. I mean, there are very sophisticated, smart MBA types at these private equity firms and at these strategics who will look into the numbers, whether it's analyzing your EBITDA, whether it's working capital, and you want to have smart guys that are able to push back if you have an aggressive buyer that's trying to reduce EBITDA or sort of require additional working capital.
Yeah, one last comment I'll make, I guess, to set you up for success from the regulatory perspective that I don't think we mentioned yet, is doing some internal billing audits and clinical audits. Your buyer, like Mike said, diligence is increasing. And in addition to a regulatory attorney like me doing diligence, you might have a billing coding consultant come in and ask for a sample of claims to review. And you want to make sure you have that all, clean before you go into the process, so that you can say with confidence that you don't have any billing and coding issues, because if those are discovered during the process, they can really thwart a deal.
Yeah, and it's important to remember, just to pick up on a comment that Craig made a few minutes ago about, frequently there's rollover in these transactions. Frequently, especially in this environment, there are earnouts. All that goes to continued seller participation on the deal. And so thinking about what that relationship looks like, making sure, one, that you're choosing the right partner to continue on your journey, but also that you're structuring the deal in such a way that the goals that are being set out for you are sustainable. You have the appropriate level of continued control with respect to the day-to-day operations of the business. All, really important to ensure that your transaction ultimately becomes a success for everyone involved. Having great advisors around you will help you do that, but it's something that you need to make sure is on your internal checklist.
One last point to that. It's, we have it defined as life after the deal, right? And that's defined as an extra exhibit A to our LOI. And so our LOI process letter. And so when we send that to prospective buyers, we have them literally go through this exhibit A that has 20 to 30 different questions about life after the deal. How is the practice going to be run? Who's going to make the hiring, firing decisions? Can I moonlight? How many MLPs can I bring into my practice each year? What does the clinical board look like, and the executive board and overall board look like? How are decisions made? Like I said, so you still retain that autonomy that got you into being an entrepreneur and providing care across the healthcare landscape. It's not, I'm going to sell my business and now somebody's going to tell me what to do. It's truly a partnership, and we actively negotiate those, so there's no ambiguity post close.
I love that.
Craig, if I can pick you one quick moment, and then Chris, I'll let you bring us home here. What this really culminates for our audience out there is, generally speaking, our folks that we support usually have one opportunity to transact their life's work. And if there's one thing that we can implore you today, whether it's with Nixon Peabody Line or whoever, make sure to have proper support with you, because there's so much here. And for the broader team, I know I can attest that we could probably talk for another 6 hours and we wouldn't scratch even, a dent into what really goes into a transaction. Get really smart folks around you that do this on a daily basis, and you will ultimately end up with a better outcome. Please don't do this on your own. We would hate for a negative outcome for anyone that's out there.
I don't think there's a better way to end it than that, Tim. Thanks very much to Craig, to Mike, and to Rebecca, and to you, Tim, for co-moderating the panel today with us. I think it was a great discussion. As you said, any segment of this could have been its own webinar. So we know we've just scratched the surface. And please, to anyone in our participant community, thanks again for attending. Please feel free to follow up with any of us with any additional questions. You can also go to nixonpeabody.com and register for topical alerts that interest you, find a bunch of content on this and related topics. Tim, where should we point people if they're looking for more information from Align?
alignba.com. And we're there and looking forward to speaking with anybody that looks help. We're in the market just to help and provide guidance.
All right, terrific. Well, thanks again, everyone, and have a great rest of your day.